Evening, everyone. Thanks for joining. The reason for doing this evening is just the constant conversations that I'm having every day around HMO values and how they align. This is not just about sales values, but any form of valuation that we're going to try and delve into tonight. I've prepared some slides around kind of why valuations have changed and what we can do to mitigate them from wherever you are within the HMO sector. But I want to kick off this evening because there's a little bit of uncertainty and market change at the moment, hence this webinar. But actually, the graphic that George produced sort of blew me away, really, and it was really interesting to see that. And it's publicly available, but it's nice to have someone kind of send that with context. So I actually just invited George Sanford, senior advisor from Vibe Finance, at the beginning of this webinar, just to set the scene around the current market. And then what I'll do is I'll carry on and talk about HMO values and what that impacts and how that impacts the value of your HMO right now, wherever you're at, where in that cycle, really, whether you're developing, looking at a refinance, or possibly at some point thinking about sale. But the values of HMOs affects us all wherever we are in that life cycle. So what I'm going to do a quick introduction, George, if that's okay.
Yeah, perfect. No worries.
So George from Vibe Finance, what keeps you busy on a daily basis then?
Yeah, absolutely. So firstly, thanks for having me on. So I'm George Sanford. I'm Senior Specialist Advisor at Vibe Finance. So we're an award-winning specialist finance brokerage. We work solely with investors and developers, covering all aspects of investment property finance. So whether that's HMOs, we cover bridging development. We also cover commercial properties, buy-to-let, holiday lets, multi-unit blocks, all those kind of weird and wonderful things. So yeah, sit across that whole specialist sector. And as you alluded to, the last month or so has been a particularly interesting one, keeping us busy.
Yeah.
So if I dive straight into
I'll pull up this. So I think as underpinning that graphic, and we'll just let George put that into context and overlay it, really.
Yeah, so I'll talk through the graph firstly, and then I'll kind of go into a bit more detail around each point. What you're seeing here is a graph. I think it goes back to the end of 2024, actually. But this shows the SONIA swap rates. Now, this is probably your best indication of where mortgage rates go. A lot of people look at bank base rate, a little bit of an outdated way to look at it, to be honest. SONIA swap rates is the thing you want to be following if you want to kind of stay on top of that. And the website, as Rich said, is publicly available, this information. There's a brilliant website called Chatham Financial that I'd highly recommend anyone that wants to follow this stuff or is a bit of a mortgage nerd like me. Log in and you can see this data, and it's updated on a daily basis. So what you'll see there kind of back end of 2024 is obviously that kind of higher end swap rate stuff we had coming out of there. And then over the kind of following 18 months or so, you can see that steady decline until that first arrow at the bottom there, which is, I think there's 27th of Feb is the actual data point, but that's kind of obviously just at the end of February, just before this kind of war with Iran, Middle East situation really kicked off. So the first time we saw that really hit the mortgage market was kind of the week commencing the 9th of March. So that's when we started seeing lender emails coming through saying pricing's increasing, rates are going up, withdrawal pricing. Now, as I say, those that follow SONIA swap rates would have seen this spike, and that should kind of not ring alarm bells necessarily, but it should give you a bit of a heads up that, right, okay, things are going to be changing and probably changing fairly rapidly. I mean, you can see on that graph how much of a spike that is rather than like a gradual increase or gradual decrease compared to the previous 18 months before it. So in the first 2 weeks, so between that arrow at the bottom there and the arrow at the top pointing down, that's about a 2-week period there. So from the kind of 9th of March towards the end of March, that's where we saw loads of lenders across the whole market, buy-to-let, HMOs, commercial, across the whole space, doing one of two things. There was lenders that were increasing pricing. So they stayed in the market. They still had a product available, but they had to put the pricing up on that. And there were lenders that were withdrawn from the market completely for a time. So they were looking at this spike going, right, okay, we don't really know where to price ourselves. We're going to take back certainly all of our fixed rate pricing. They might have kept some tracker or variable products in. But actually we're going to step back completely and just not accept any fixed rate business for that time. So one of the key things to note when this kind of thing happens is that as brokers, we get advance notice of this. So the lenders will send out an email, right, okay, rates are being withdrawn at 5 p.m. today or whatever it may be. Some lenders won't give us any notice. Sometimes we'll just get an email saying products are withdrawn or products are now higher. So really important to be kind of staying on top of these things or working with a broker that is definitely. Those that were increasing the pricing rather than withdrawing pricing faced a really difficult job. So you'll see in that graph is kind of two distinct spikes. You've got this first little spike and then a tiny little drop and then another spike. So what they were battling with is obviously they still want to remain competitive in a market. Don't get me wrong, lenders need to lend money to make money. There's no lender out there that doesn't want to lend money as much as their underwriting process might make you believe it. They all need to be lending money. So their pricing is really important for them. So they wanted to stay competitive, but obviously trying to stay on top of this volatile swap rate market meant that we were seeing the same lender maybe reprice 3, maybe even 4 times within the same week. We had lenders literally reprice on a Monday night, and then we get another email late Tuesday saying they were going to go up again on the Wednesday. Now that's the kind of speed these things can move at, and shows that the kind of little notice that they're giving. So that's really important to note. Those that withdrew their fixed rate pricing took probably what is a safer reputational option, i.e. they weren't kind of looking quite as bad, but it did mean they were lending probably next to no money during that period, which is obviously not great for their kind of back book. So there's kind of arguments to and against both situations. Thankfully, as of today, pretty much, I think, as far as I'm aware, every lender is back in with their fixed rate pricing. So if you move on to the kind of last part of the graph there, you'll see that little decline. So that's really the last week and a half or so, kind of from the start of last week. So it's kind of steadied out a little bit. As you can see, it's kind of dropping down slightly again. So this has kind of encouraged the lenders to come back in. And if anything, shows that the market is quite resilient. It's quite keen to recover by the macroeconomic things allowing that it will do that. Just to put some numbers around this for you guys, the top peak you can see there, where that kind of top arrow is, that's a SONIA swap rate of about 4.5%, which isn't, if you look really long term, isn't abnormal. Anywhere between kind of 3.5 and 4.5 is kind of historically average. But obviously that significant spike is what causes the kind of panic as such. Now, Rich obviously talks a lot about over leverage and things like that. So who benefits from this situation? Well, nobody really benefits, but who's best protected are those that are stressing their deals in the right way. So not over leveraging, making sure that actually, okay, great, rates are 4.5% today, but what happens if they turn into 6.5% when I need to refinance? So making sure your deals are protected by that. And also those that are, we call it document ready. So if you were looking to refinance or purchase a HMO at the start of March, you would have been directly impacted by this spike in rates. There's not much you could have done about that. However, being document ready, and by that I mean having ID, pay slips, proof of income, proof of address, bank statements, ready to go, labeled, neatly packaged documents, that would have meant that as a broker, we'd been able to submit your case more or less immediately, locking in the rates as we quote them, rather than if I quote you something on a Monday, that rate could have been 0.5% higher come Wednesday. When you've tried to pull those documents together. So again, just to finish up and round up, so just to put some numbers around this for you guys. So kind of, if we looked at the start of the year, so January, February time, HMO rates kind of sitting circa 5.5%, depending on how you want to play it with lender fees for kind of a fairly bog standard case. That's kind of spiked up a little bit. You're probably looking at kind of 5.5 to 6 for your bog standard stuff now. The caveat to that is you've still got the specialist side of the market. So your larger HMOs, your property situated above or very nearby commercial, supported living, maybe complex client profiles, adverse credit, expats, foreign nationals. So you guys are going to be sitting probably kind of 6.5 to 7 at the moment. You'd have been 6.5 before. The specialist side of it, I should say actually as well, probably impacted slightly less. Kind of trickles through. So you'll see the high street get hit first, the more bog standard lenders next, and then the specialist lenders go last. So the specialist lenders have had a lesser impact because they build in higher margins, because they take in higher risk profiles. They can kind of swallow a little bit of it. But as I say, the market's heading in the right direction now. So this is as of this afternoon, this graph. So it's heading in the right direction. I think the market looks fairly keen to recover. We've started seeing our first set of lenders reducing pricing, taking it kind of back towards where we were previously, which is obviously great. So yeah, I think that's kind of an overall summary of where we are and what's happened. And hopefully what will continue to happen is that kind of dropping down into that kind of 3.5 to 4% range. and a bit more stability.
Brilliant. Thank you, George. I appreciate the short notice as well. So I hope you found value in that, because this was going to be a quick me regurgitating George's advice and just giving a summary from his perspective. But the fact that he wheeled out that graph and then a lot of context around it, I thought I'll just start tonight with that and then liberate George to go and tend to his kids and his family in the background, because this was very much short notice. So yeah, thanks for that, George. I appreciate that so much. That was really good and sets me up for the context of the wider valuation picture really brilliantly. So appreciate your time this evening, mate.
No worries, guys. Thank you. Have a great evening.
So what I'm going to take with that and carry on going through is how to apply that now to HMO values, because the values of HMOs are underpinned by who buys them. And, obviously valuers go out on behalf of lenders, but they're looking for comps, and everything relates around the prices that are being paid for HMOs. I wanted to do this webinar because I've been saying, as George said there, he referenced back to January, February, we were in a very stable, yes, interest rates were higher than they were pre-Liz Truss, etc., but we were in a bit of a stable sales window. We knew what the stamp duty was, the high stamp duty costs, we knew what interest rates were, and when things are settled, people are buying, and yes, they might be factoring in that into their offers, what have you, but in these areas of volatility, people stop buying, and then there's a new normal being created after that. My concern about the buyer market is, if this is a protracted window of volatility where people are waiting for lenders to get their houses in order or just watching the market, we're walking straight into the Renters' Rights Act due in at the end of this month, and then traditionally we go into a summer market where things dip down. So one of the things that I'm trying to watch is that this little hiccup with the Iran war doesn't just take us into 6 months of slowdown with HMO sales, slowdown of HMO sales at yesterday's price, and to trigger the market, is there going to be a new price normal? Because that new price normal is going to impact all of us trying to refinance at the back of the year, refinance in 2027, when the comps start coming through. What's the legacy impact of this 2 to 4 week issue that George has outlined? If that extends with buyer nervousness around other factors that we're dealing with in the HMO industry, then it's my job to try and talk about that and advise on that. So what I'm going to do is go into some slides from my side, and I hope again that you can see them all. So yeah, applying what George has said and applying to what we're talking about with regards to all the other factors to do with HMOs, what I like to do, first of all, put it into the context of who's this for. So I talk a lot about valuations. I talk to people looking at selling. And traditionally, over the last 5 to 10 years, most of the people I chatted to about HMO valuations were just those approaching wanting to sell. But now more and more, the majority, in fact, is talking to HMO developers, people that are creating HMOs. Somebody's on this call this evening that I've just met earlier on to talk about their GDV finance valuation. Most of my conversations now are about people looking to leverage at any point within HMOs. So that applies to developers creating them, HMO owners, because at some point, 3-year fixed, 5-year fixed, you're going to be looking at refinancing. So anybody in the HMO sector, the values of HMOs affects us all. So that's who this webinar is for. So if you own them and you're in them and you're looking at creating them or operating them, hopefully you'll get something valuable out of what I'm just about to cover. So I always like to, if you've heard me do any talks at any events, etc., I always like to sort of set the scene, because a lot of the people have come into HMOs from around this time frame or learned about HMOs as a concept or as a strategy in a different market. And then the context of the market that we're in now is really important to overlay against maybe days gone by. So I always pick a date, 2018, because it's kind of pre-COVID, pre-certain changes. But let's picture the scene. So imagine a HMO, you've gone off, apply this to wherever you are in the country. So, the purchase price of 100K won't be relevant to you wherever you're sat, but it might be for some. But just factor in the costs of this wherever you're based. But 100K purchase price, a development cost of 100. Overall, with expenses and interests on borrowed money, etc., you may have spent 220 to create a 6-bed all-ensuite HMO back in the day. Rental income, so 40,000 gross. I think I did this afternoon. I did these slides in between landlord market update Zooms this afternoon. That was about a 550 average per room per month, etc. And you financed it at 365. So wow, you've managed to do a loan of 273. It's more than an all money out deal. You know, you've got money back for refinancing. The equity uplift that you've created far and exceeds the level of expenditure that you've put in. Great. That is a perfect HMO model. Going into numbers in more detail. So at that point, your operational expenses, so the running costs for the property in the region of 20 to 25% will give you a net rent. This is pre-tax and lending and attributed costs, but a property net rent of 27-ish to 32. So you're seeing the kind of margins deducted off that gross rent. Again, wherever you are, if your gross rent was bigger or lower, you can still see the variables and the margins. 8K-ish on mortgage. You'll fall out of bed. This is what we always say. Previously, in the market gone by in 2018, even a 5-bed ensuite HMO would give you £1,000 a month net. A 6-bed, well-run HMO, post-refinance, taking all your money out, you'll get 1,500 quid and more some net quite often every time, you know, at the end of the year, once you've put money in for, you know, voids, maintenance and paid your tax and sorted yourself out, you'll still come out with £1,500 a month net. You know, sort of net proceeds, net profit off these HMOs. So that was the market that we were in. And then crucially, how much could I sell that for? Because all of the leveraging at that time was based around a buoyant sales market. So in 2018, I was doing every fourth Friday a webinar to Hong Kong investors. I flew to Zurich twice. I flew to Dubai to meet investors. We had things like home REIT, institutional funds. So the resale market, to pin the same value as that you were leveraging at, I could sell, and in some cases I could sell for more than the value that they were created for and financed at. Why? Because these properties had very good positive cash flow. They had manageable expenses. So, you know, the cost of living crisis hadn't happened. The energy bills hadn't gone up. High tenant demand in a lot of these areas as well. So a lot of these HMOs were created pre-Article 4 in untapped locations where new boutique, just like that picture there, new boutique style ensuite HMO rooms were not the norm in these areas in 2016, 17, 18. So you took a product to the market like that and you get high tenant demand. And obviously from a buyer's perspective, yes, they had the option to add value and go and find one. But if they just wanted to bulk into, you know, buy into a load of cash flow and some, you know, decent fixed returns with a managing agent outsourcing everything, they had really low interest rates and lower stamp duty at that point. The 3% surcharge may have been in effect. I can't quite remember, but definitely the 5% hadn't kicked in because that was a couple of years ago, October. So a really buoyant resale market, which underpinned all the finance comps at that point. So now here we are, 2026. So the value of this HMO was previously determined at 365. This is the property that we've just gone through there. 365, and the same owner may have financed a few times at that level and it may be still held at that valuation point. Gross rent 40 grand, as we've explained, but now the running costs, rather than being 20 to 25%, we're now looking at running costs 30, 35, 40% if you factor in voids and if you factor in churn, delinquency, costs of operating them. So the net rent starts to tumble down. But also adding into that to compound that kind of squeeze on the cash flow. If anybody has had to refinance post Liz Truss with that 3 to 5 year fixed period post Liz Truss, then you've started to sort of go up from 3s, 4s, 5%. As George says, some people are now into the realms of 6% to refinance. So the mortgage squeeze, I was talking to someone this afternoon where it's about £28,000 a year on interest only mortgage with 55, 56 grand rent roll. So the mortgage rises has really started to cripple the cash flow. So on the same property, same HMO, you just start to reduce that cash flow down with, you know, and somebody said to me really, really interesting the other day that it's always worth factoring in that at times like this, so George has just come on and talked about SONIA swap rates going up, which lending costs go up. as a knee-jerk reaction. But the oil prices, we might not see that on our energy bills immediately, but you're going to feel it on the call-out charge of the handy person, handyman, handywoman coming out to your property. They're adding on an extra 20 quid to cover their petrol costs. They're adding on, everything becomes more expensive when the price of oil goes up. So the actual cash flow of these HMOs has started to really be impacted. So that has an effect on value. So as a new investor, if you don't already own these properties and if you've not done a BRR originally and taken all your money out, we're now expecting people to come in and pay 365, tie up 25% capital, get an expensive mortgage, roll up the arrangement fee and take all those higher operational expenses at 365. And the reality is they're not going to do it. Only the people that are still holding these HMOs are the ones that did the original BRR when 2018, 2019, 2020, whenever it was, when it was a no money, an all money out deal, etc. So in this example, with the rent at 40 grand current value, if you transfer the same return on investment or the return on capital employed or the same net yield, if you transfer those metrics across, you're going to be in the region of 250 grand for the same HMO that was financed at 365. So that's an extreme example. It's £115,000 drop in value. Why? Because of higher operational expenses, higher stamp duty, and you have to stimulate the market. So I have to get a tune out of the buyer market to say, for me to engage and for me to buy a HMO, it has to operate 2 or 3% better than the average buy to let in that area for all of those headaches and all those potential variables. So I'm at 250, take it or leave it. So that's the extreme example of where the sales value is. Looking at that in reality of the gross yields, in 2018 at 40k income, 11% gross yield on refinance was 365. To get to the same net return on a poorly or average optimized HMO, we're at 16% gross yield. So that yield drift reduces the price by that 115,000 because the high yields that need to make the HMO stack. So the values are going down if that rent roll is remaining stagnant, and that's really important. But the positive with all of this is that every 10 grand's worth of rental increase over that time, over that 6-year period or 8-year period actually, is worth 62.5 grand, even at 16% gross yield. So focusing on increasing rent roll, quality HMOs in good areas, if that rent roll goes up 42, 45, 47, 53, you're increasing the value of the property despite having a multiplier that's gone up from 11% to 16% gross yield. So to put that into perspective, the maximum drop in value of that property in the worst case scenario, if it stayed at £40,000 worth of income over that time, and many HMOs stay at a stagnant level of income. So it's not a given that HMO rent rolls go up if they're in a bad area or saturation or if they're badly managed. But the positive is that the high quality rooms in that area on this example, rather than being 550, they might be at 750 now. And rather than being at 16% that buyers need to be or lenders need to be drifting that gross yield up to 16, a well-optimized, well-run HMO, you're not going to be at 11 like it was in 2018, but you might not be at 16. So if you just take a couple of percent off and add in 150, whatever average per rent, per room per month, all of a sudden, 54 grand's worth of income at 14% is 385. So you're coming out with a 20 grand increase in value across that tough 8 years where everything else externally has gone against you, interest rates, operational expenses, compliance, legislation, everything is out there to trip up HMO landlords. But if you focus on quality locations, understanding your tenant demographic, even despite all of those challenges, which hopefully we won't have that same 8 years again, you may be in a situation where the resale value is 20 grand more than you financed that a few years ago. And that doesn't feel like a lot of capital growth, but when these properties have been valued on their commercial kind of validity, these aren't bricks and mortar assets that just go up year on year in accordance with the local bricks and mortar market in that region. These are investment properties that have been valued on the investment potential and the investment performance. So if running costs increase, the gross yield's got to increase. The gross yield increase to factor in more operational expenses, you're dividing the rent roll by a higher number and you're reducing the value. So the big thing is get it right in the first place and increase that rent roll. So what am I seeing in reaction to this? So at the moment, my day job is filled with people trying to inflate their GDVs, gross development values of their HMOs. So people are still out there creating and developing HMOs. Which is fine. And especially on the 5, 6, and 7 beds, because the build costs have gone up so high in the middle portion, I'm seeing a lot of people falsely or attempt to falsely inflate their GDV to mitigate extra costs elsewhere. That's a big red flag. Look at it as a long-term, project. Look at it as long-term, 5 years minimum, 10 years ideally of these HMO ownerships, and then you won't be in a situation where over leveraging kicks in. But if you inflate your GDV early on, 3 to 5 years later, you're going to be at risk of having an asset that's worth less than you financed that originally. So you've really got to look at not pushing room rents up to a false level where they're going to start to regress, because that's the quickest way to have a down value of HMO. And then if macroeconomic situations, as George says, if external factors push that gross yield up, you have the double whammy. So you've got the double whammy of rents going slightly down, the market slightly getting away from you, and that drifts to a significant reduce in value. So really watch that, please, as you're developing them. Regression of gross rents or occupancy, to follow up from that. So in particular, in high demand areas where everybody goes in and creates ensuite style HMOs, as a rule of thumb, I see a lot of areas. I don't want to name locations, but they go in 750 for a studio style ensuite room. I go back to those properties 2 years later, and they've settled at 675 to 700. So they've just dropped by 50 quid a month per room, and then there's no problem with a brand new HMO, brand new product taking that 750. Not a problem at all. But if you just need to know that if you leverage at that 750 and then your rents regress, you're going to have difficulties when it comes to the future valuation of that property. And the gross rent can be affected by a regression of the kind of room rent, or if you're hanging on to that price, then you'll start to see occupancy. You'll start to struggle to fill rooms and you'll carry voids, and that will come out in the wash when you're trying to sell or when you're trying to refinance as well. Another thing to watch and be really careful of, too much debt that's being carried. So obviously we talk all day long about primary debt and primary leveraging, but there is a lot of secondary debt on personal guarantees and private investment that gets held on HMOs. From my experience of assessing hundreds of these every single year, this secondary debt, the primary debt is the thing that pinches your cash flow in the first instance. The secondary debt, carrying private private lending and private and passive investment on an interest rate that you can't pay out because your GDV is not high enough. Maybe the bill's gone over budget. If you're carrying passive debt on the cash flow of a HMO, management and maintenance and capital expenditure, all of those things start to wane. So you're less attentive. You've got less budget to look after this property. So it's harder to keep them at that high gross rent roll. So they start to naturally drift down the ladder in terms of, the 750s are reserved for the well-run, brand new or really exceptional HMO rooms. You start to dip to the 650 range. So it bites you on the backside, either way. And carrying too much debt on an ongoing basis is one of the quick ways to have a sliding scale of HMO value. The other thing that I'm seeing, smaller HMOs are harder to develop. So that's primarily, I've said to a few people today, I've done loads of Zooms today, that bricks and mortar values have gone up a bit post-COVID, a bit of a drop, a bit of a jump up, and then sort of the asset value of the properties to turn into HMOs have gone up. But the big factor is the exponential growth of the build phase and the materials and the labour in the middle. If you're doing an average previously 70 to 100, and now you're at 150 to 220 to create these HMOs, it's a huge jump up. What that means is a lot of people that used to develop are now looking at the ready-made market, and if they're happy to pay good money, I can still get good comps and deliver those good comps out so we can all leverage and refinance off decent priced HMOs. But ultimately, quality always wins the day. So whether it's picking the right area, picking the right tenants, understanding the local demographic, building it well, focusing on your longevity of maintenance and management, always focus on quality and don't focus on the top bullet point, inflated GDVs. But if you go on Instagram, go on training courses, it's all about pushing a GDV. where potentially focus on quality and leave money in if you have to at the moment. That will serve you best in the long run. So things to consider. I wanted to put this on there. Yesterday, I had a conversation with somebody with 4 properties in an area. They're looking at selling 4. We're onboarding them and we're going to launch them for sale. One of the 4, they're in a position to sell for significantly lower than the other 3 because of it's unencumbered and they want to get out and they've gone overseas, etc. So they said to me, "Can you just fire sell that one out? I'm happy to accept 80 pence in the pound, get it gone, chuck it through HMO X auctions, and then we can focus on the other 3 in terms of a full value." I said no, I didn't want to do that, and they were quite shocked because obviously, give me a cheaper HMO relatively, whack it through auction, I get a fee quicker, happy days. But I explained the impact, what that would mean on the comparables, because if I then sell one for 380, where the others I'm trying to sell for 450, the local recent comparable that value is going to go out and see is my sale at 380. So all of a sudden, the finance valuation of the next 3 is going to be hindered by them fire selling the other one. And as soon as I explain that to them, we're re-strategizing and we're looking at getting as much value as we can out of all of the 4, because it's really important, because there's a lack of comps hitting the market. If you go on Rightmove, as I do every day, look at the markets, look at the portals, speak to agents, lots of HMOs go under offer, but you need to look at what they hit land registry at and what they actually complete for, because a completed sold comp of a quality ensuite HMO, the types that you're creating to refinance, they're as rare as rocking horse, so that is, the comps and focusing on them. Another sale that's going through at the moment that I'm aware of, the properties are consistently in that area, financed between 420 and 425. It's been, you can, pin the tail on the donkey in terms of that's what the 6-bed ensuite HMOs value at, if they're well run, if they're good quality, and if the rents are at that certain level. 420, 425, that's the range. The sales market right now is down to about 400 to 405. So a sale has been agreed at 405, but it's going to go through the purchase at 420, and there is a separate deal to reimburse the balance, because the comp at 420 is really, really key, because it's important not to let this market drop down and suddenly that's the next level of comps that we're all financing off. So watch comps, and if you get a comp that suits your property and suits your product, hold it and hold it dear, because that's going to serve you well over the next 6 to 12 months. So the impact of leveraging over the long term is something to really consider. So what does it mean that first time that you finish a HMO and you've financed at that level? Sit down with yourself and your business partners and your family and look at it and say, we've pulled this money out. We've been told this HMO is worth this amount of money. What things need to happen for that to be an over leveraging situation? And look long and hard over the impact of leveraging. So leveraging is a good thing to grow portfolios, but with HMOs, there is a tendency to have it as an over leveraged vehicle. That's because of the training and education over the last decade about HMOs. They are not a strategy. They're there to solve a local housing need. So really look at the leveraging aspect of these HMOs. I missed that bullet point, the real exit. Think about when you're buying HMOs. Again, I was with somebody today who said what a lot of people say: I want to develop this, keep it for 15 years, pass it on to my kids. Your kids probably don't want to take over a 15, 20-year-old tired HMO when they want to go traveling around the world, or whatever the world is happening in 15, 20 years. They probably don't want that. However nice it sounds right now, the chances are you need to think about another exit to that HMO. So what does that exit mean? Who's buying these HMOs? How do you bundle it up? And how do you make it a tax efficient or successful exit for you? It's never too early to start that process. The 4th bullet point, optimisation. So as we head past Renters' Rights Act this month, we are all going to be more and more focused on energy efficiency, running costs, and the better optimised HMOs. So if you're developing them and creating them, look at any form of solar, heat pumps, anything that can reduce the operational costs, and also the impact that external forces have on the running costs of your HMO. So really look at your energy, look at everything it takes to manage and operate them, because that will stand you in good stead for each refinance going forward, and it will stand you in good stead when it comes to ultimately selling that asset for as much money. And the big thing that underpins everything with HMOs, there are You go into them because of the multitude of cash flow. Each room is paying you rent rather than a standard buy to let. Focus on areas where you genuinely know you're going to get rental growth year on year, whether that's just natural inflation-based rental growth, but rent regression can kill these HMOs if, as we've proved, external factors move yields in the wrong way. So it's all about the rental growth to maintain the value of these assets from what you originally leveraged them at. I wanted to do a final little piece on who's buying them. So who is currently buying? Because I always talk about the previous days of, Hong Kong or home REIT, etc. And lots of, when interest rates were lower, there were just casual investors buying established HMOs. So at the moment, there are cash buyers out there wanting a deal. So our offer levels have gone up recently. Cash buyers looking at 75 pence, 80 pence in the pound, looking for those tired landlords that just want out. I always stand by that comment that I started using last year. Buyers in this market for established HMOs, our job is to make it ideal for them. And if it's not ideal, they'll expect a deal. Somebody's on this webinar this evening that I've chatted to today as well, where I've said to them, thank you for, potentially asking me to instruct and sell your HMO next week, but we need to wait 2.5, 3 months so I can increase the value by X percentage and work to make that HMO ideal for the buyer market rather than a deal, because it will impact the percentage was 5 to 8% lower than what I think I can get for it just by waiting and optimizing and timing the market to suit that particular HMO and that landlord circumstance. So landlords that can no longer justify developing are also buying. So going back to the previous slides around build costs increasing, so they are buying. If you're operating in a local area and you want to grow your portfolio, you're looking around, especially in Article 4 areas, and thinking, shit, I can't buy these properties anymore and build them and create them, but I can buy off the landlords locally and gradually improve the stock and grow my portfolio via, established existing HMOs. We still get high net worth funds and overseas investors. So the slight positive at the moment around the changes with the Iran war, etc., is we've suddenly a few more Zooms with clients based in Dubai, Middle East, and Turkey most recently, because they were traditionally investing in the Middle East and now they want to start looking at England as a bit more established, European markets. There are still investment funds that are buying HMOs. I've got a high net worth meeting me next Wednesday to do a portfolio tour to look at some HMOs. So those buyers do still exist. They are massively focusing on the net return of these properties, no longer being blinded by the high gross. It's all about securing the net. So the more you're on top of your kind of operational expenses and guaranteeing the rent roll or showing evidence that rent roll is going to increase, these buyers are buying, but they want certainty over net returns. Lots of people asking for business purchases out there, coming in saying, look, I'll buy the shares, I'll buy the limited company to save on the punitive stamp duty, 0.5% to buy the shares rather than 5% surcharge on top of 2, 3, 4, 5% normal stamp duty rate. The big thing to concentrate on there is, are they experienced? Do they have the right team in place to act quickly? A lot of people see the headline about buying a business and saving stamp duty, and then they don't have the experience to execute it very quickly. So the conveyance, even though it's not a conveyance, the business purchase quite often is over a year to get those things through. So just factor that in if you're thinking of building and selling your SPV with properties in. But make sure that the buyer on the other side is not just seeing the headline, but understands the capital gains, the inherited liabilities, and the transaction to get through with all the consultants and solicitors charges that are involved. And go back to that sentence that I mentioned at the beginning, making your HMO ideal will increase saleability overall. So how can we help with anything from HMO X's side? With all that in mind, GDV appraisals is one of the big things that we do every single week. So if you are developing HMOs and you are unsure or worried about where that valuation should be, I get a lot of good feedback from people saying, oh my God, amazing, thank you. You helped to find the comps that supported my valuation at the high level I wanted. But equally today, I had a voice note from somebody that said, thank you for your report. I'm so pleased I decided not to go ahead with that property, and I said no to the property sourcer that offered me the deal because I realized that rents were inflated and the GDV was inflated on the deal that you assessed for me. So whichever way you come from, my reports on GDV appraisals hopefully will give you the right advice. If I can justify a high valuation, I'll give it you. And if I can't justify it, I'll tell you why. But it saves you going into a deal and building something out that you end up having in your opinion, a down valuation on, and the whole thing unravels. If you're due for an upcoming refinance, that is a trigger for a lot of people. A lot of landlords, they think, look, should we refinance and lock in, or is this the time to sell? So we do a little bit of an exit planning or an assessment for people in that bracket where, you may be 5 years away from selling, 36 months, but start to think about and optimize your exit, because the clients that we work with over a longer period of time get the better sales value, because we can tell them when to pull the trigger and how to prepare their HMOs for sale. So if you're in that bracket, we can help you on that. And if you are in the current camp of, right, how does all this affect me? If you've joined this webinar because you're thinking of selling imminently, call in with me and I'll overlay the market trends currently right now, that 0.5% increase. How do we get the stability in the next couple of weeks without going straight into the Renters' Rights Act and maybe that market noise? And how do we time a sale between the Renters' Rights Act coming in and the summer slowdown, etc.? If you want all of that being assessed, book a call. I'll do a one-to-one 30-minute Zoom to go through everything on your personal HMO and personal circumstances. So I tried to rattle through it to be as concise as possible. As always, in the background, there's going to be a follow-up email sent out so you can ask any particular questions. But what I'm going to do, who wants to drop a quick question, any question into the chat that I'll answer quickly. If anyone wants to stay on for a little bit of a Q&A, I could do the next 5 to 10 minutes just on a Q&A. Anybody specific? I can see one in the chat here. Observations last 6 to 12 months is developers overpaying at the start, especially when moving from one area to the other. Oh, perfect. There we go. Thanks for that, Holly. Especially when moving one area to the other with higher rent, stronger yields and GDVs, then generalizing the same figures to a new area, not realizing the local market. Yeah. So what that question from it's a bit of a question or a bit of advice from Carl is saying that really, really important. A lot of the time with Article 4 areas, developers, they might be in the city of that region. They're developing and they know the yield, they know the rent roll, and they know the margins of that area, and they know what they can create these 6-7 bed HMOs for. All of a sudden, Article 4 comes in, or they worry about demand, or costs go up, or rule them out of that area. So then they move to the town, the secondary town on the fringes of that city, and apply the same metrics there and go, wow, I can buy it all of a sudden. Rather than paying $250 for this property now, I can pick them up at $150, still the same build cost to execute them, and they expect all the finance variables to be like the good old days. But you are developing HMOs in a market with less professionals, less people that can afford that 700, 750, less of a demand, and potentially, even if you get away with it on that refinance in those areas, because the lenders are still happy to give you an equivalent valuation or yield, what they'll do is in 3 to 5 years, your rent roll will start to regress in those secondary locations, unless genuinely you've spotted something that others haven't and you're a local knowledgeable expert of that area. I am well up for doing follow-up one-to-ones with anybody that wants any advice at the moment. There are lots of nuances that are affecting the values of HMOs from any angle, from the GDV right the way through to owning and selling imminently. So if you want my advice on anything, please get in touch and I'll book in a call with you. Thanks for being part of this evening's webinar. It was a good turnout and I think it's a very relevant subject. Hopefully I've covered everything that you were hoping for, but if you need anything else going forward, you're going to be thinking specifically about how does this impact your individual property, your own refinance, your redemption penalties when you go on to the fixed variable, the variable rate, etc. So please get in touch and I'll help specifically as a follow-up. So thanks for your time this evening. Enjoy the bank holiday weekend and I'll speak to you all next week.